Hello, friends. This is Jake. Hope you all are doing great. Thank you for joining me on this video. In today's video, we're going to talk about two topics. The first topic is going to be about my portfolio update, and the topic number two is going to be margin. What is margin? How it's calculated? All the details. My last video was about reaching my first milestone for this portfolio, reaching 100k. Looks like my portfolio drank some Red Bull this week. It's sitting at $105,000 as we speak. $500 of this kind of $5,000 gain that I had this week is the money that I made from options. Remaining $4,500 is thanks to the crazy market. Okay, to be more candid, these are my trades for the week. I bought $575 worth of ETFs this week. This include KBWY and SCHH, both are ETFs. I also received $100.95 in dividends this week, mostly iShares dividends. I also made $524 in options trading. So those option trades are, the first one is Airbnb 155. I sold a covered call at a strike price of $155. So that made me $130. And then I sold a Square short call. So that means I bought back that week's covered call and sold it for the following week. Same thing I did for Disney. But in this case I did not get a credit. Instead, since the Disney price went up, I had to pay a little bit money, $29, to buy back the stock and sell another one. Microsoft $16, and in the same week I sold Airbnb again for the following week at $197. So all in all I got $524 for the week in option premium. In summary, I only use money made from dividends and option trading to purchase before mentioned ETFs. And this is how I plan to grow this account into a 250k portfolio in 3 years. Also, let's take a quick look at my portfolio performance. As mentioned before, for the week I'm up by $4,981. For the month, I'm up by $10,700 or 11.40%. For the last 3 months, I'm up by $25,000 or 31.71%. And for the year, I'm up by $36,000 or 53%. And overall, from the beginning of time, I'm up by $41,000 or 66%. Now, all these gains take me to the next topic, margin. Why? Because some of my returns can be traced back to using margins. So what is margin? In simple terms, margin is borrowed money used to buy stocks, ETFs, any equities. Now, if you Google it or read through Robinhood's help section, we can find the classical definition of margin, and you can read through it and not really understand it. Why? Because in most of the cases, margin is explained using a single stock, and it goes like this. Problem with this explanation is that most people take their margin on their 10th or 11th stock, and this 10th or 11th stock would be completely bought on margin. And from the account holder's perspective, it doesn't look like they put up 50% and they only used 50% margin. From their perspective, it would look like they bought the entire thing on margin. So in this video, I'll explain how margin is calculated in Robinhood and the things that you should be aware of while using a margin account. To understand margin, we need to understand few concepts like initial margin, margin maintenance, and margin call. Also, there are a few key players in this margin business. There is us, the account holders, then there is the lender, that is brokerage like Robinhood, and then there is the regulatory body like FINRA and SEC. So the regulatory bodies has made some basic rules regarding margin business, right? So the rule number one, FINRA or Financial Industry Regulatory Authority mandates that investors should deposit at least $2,000 before trading on margin. There is nothing much to it, it's just a rule. Rule number two, only up to 50% of the required cash can be borrowed. So in a portfolio, it works a bit different. I'll explain that later in the video. So why do we have this rule? This is just to make sure that we simpletons don't get into debt up to our eyeballs. Also, this helps to keep the market stable as well. Trust me, given a chance, many of us will take 100% debt. So this 50% rule is also known as initial margin requirement. By the way, brokerage can require more than 50% as the initial capital requirement. Can be 60%, 70%, 80%, depending upon how volatile the equity is. Now, rule number three, the account holder should always retain 25% of the equity while the account is in margin. So this is also known as margin maintenance rule. So what is this rule about? So market goes up and market can come down. 25% equity becomes important when market comes down. This rule is just to make sure that the account holder doesn't lose their shirt, or at least they're left with their undies. Also, this ensures that the lender of the money, brokerage, is always safe. Okay, I'll put all this together in a single narrative in the next section. In this section of the video, I'll create a Robinhood portfolio and we'll figure out how this whole margin business works. We'll go through the initial requirement, we'll go through margin maintenance amount, we'll go through margin calls, all the 9 yards. Okay, I'm going to create a 4-stock portfolio with different levels of volatility. The portfolio is going to be made of Disney, very stable, Microsoft, again stable, Airbnb, newly IPO'd, super volatile, and Square, again super volatile. So here in the spreadsheet, I've created a portfolio made up of stocks which have different levels of volatility. So the stocks that I've chosen are Microsoft, Disney, both are stable stocks, Airbnb, recently IPO'd, highly volatile, and Square, which is not recently IPO'd but pretty volatile. So though this spreadsheet will look confusing at the start, it's a pretty simple spreadsheet, so I'll walk you through it. This is our day one trading, right? So the first day, or let's assume that we had this portfolio for a while. I have $25,000 worth of Microsoft, $25,000 worth of Disney, and $25,000 worth of Airbnb, and we were happy, right? And then one fine day we thought, okay, let me add Square to my portfolio, but we only have $75,000 with us, so 25, 25, 25, 75,000, and we don't have any more money. But the good thing is we can turn on our margin account, and so there is $75,000 in equity that we have now, right? So once we turn on the margin, some amount of money will be available as margin. So that some amount of money has to be calculated to see how much is available. So though I haven't mentioned it here, there is something called initial requirement for all these stocks. So for Microsoft, initial requirement is 50%. So if you have $25,000 worth of Microsoft, you have $25,000 worth of usable money available to you to purchase other stocks. Same with Disney, but with Airbnb, that's not true. For Airbnb, as we speak right now, if you put $25,000 in Airbnb, that money won't be available for margin as it's so volatile. So in this particular example, we'll have $50,000 available as margin. But we are not going to use all of that 50,000 that's going to be available as margin. We're just going to use 25,000. We buy $25,000 worth of Square. So this is what I said earlier in the video. You have to put up 50% of whatever security you're buying on margin. It doesn't mean that it has to be on that particular stock. The overall available margin will be calculated based on the portfolio, as we see here. So here the entire $25,000 worth of Square is bought on margin. And that's because we have margin available for Microsoft and Disney. Okay, so that's this column C, right? Now let's go to maintenance requirement. So if you look in Robinhood, this is not available in the Robinhood web. You have to use the Robinhood app. You scroll down all the way to the bottom for each of the stocks. You'll see the initial requirement for the stock and the maintenance requirement for the stock. So if the stock is not volatile, then the minimum margin requirement is going to be, or maintenance requirement is going to be 25%. That means at any given point of time that you hold the shares, you need to have at least 25% equity. So let me also get one confusing statement across. Though we only bought Square on margin, once you take a single dollar as margin, the entire account become marginable. So this maintenance requirement become applicable for Microsoft, Disney, Airbnb, Square, all account as a whole. So just know that once you take the margin, we need to look at the margin minimum maintenance requirement for all these stocks. So here for Microsoft it's 25%, for Airbnb it's 100%, and Square it's 40%. So now we can find the dollar amount of that margin requirement. So you have to always also think that this margin maintenance is calculated always on the current value of the stock. So this, in a live portfolio, this number will keep on changing. Okay, so how did I get this $6,250? Basically, I got that by C3 times D3. So that's 25,000 times 25%. So, or 25% of 25,000, you get this amount. The same goes here. 100% of 25,000 is 25,000, and 40% of 25,000 here is 10,000. So as of this moment, you need to have $47,500 as your margin maintenance. That means you should maintain at least $47,500 equity in your account. So if you look here, your total, including the margin stock that you bought, you add them all up, you have so 100,000 in overall equity, right? So you have 100,000 in overall equity, including the margin. Of that, you need to maintain 47,500 as minimum equity that you need to maintain to keep this margin account, which comes to 47.5%. How do you get that 47.5? You get that by dividing margin maintenance by total market value of equity, right? Okay, so that is clear. Now let's find at the end of day one, what is account holders equity. So that means in this 100,000 portfolio, what percentage is the account holders? The total market value of equity minus borrowed money. That means this is the total value of equity minus, we know we borrowed 25,000, and you get 75,000, right? 100,000 minus 25,000, 75,000. This borrowed amount is not going to change. So 75,000 is our equity and 25,000 is borrowed. So equity percentage, pretty simple. 75 divided by 100,000, you get 75%. So this 75% is higher than the minimum maintenance requirement. So we are good. There is no margin call. The first day is good. So now we go to the second day. Second day, the market dropped and all our equities went down. So Microsoft is now only $20,000 worth. Disney is only $19,000 worth. Remember, before this, we were all $25,000. And Square is only $15,000 worth. And you have to remember, our maintenance equipment technically can change as well if brokerage wants to change it, but we are assuming that the maintenance requirement is going to remain the same. So that means 25%, 25%, 100%, and 40% for Square. You find 25% of 20,000 or 40% of 15,000. So you get this margin maintenance number. You add them all up, you get $36,750, right? So that's the minimum margin maintenance that you want to maintain at the second day. And after all these losses, now our total market value is 75,000. Here we made it $25,000 compared to the previous day, right? Because the previous day we had 100,000 overall account value. Now it's only 75,000. So we had a loss of 25,000. That ended 25,000 is subtracted from the account holder's equity, right? The borrower's money still is safe. So borrower's money is still 25,000 because we borrowed 25,000. Previously our equity was 75,000, right? Now it's only 50,000. Why? Because now the new value of equity is 75,000, and subtract the 25,000 borrowed money, you get $50,000. So that is the new equity. So to find the equity percentage, you divide 50,000 by 75,000, you get 66%. So though we lost $25,000, this 66% of account holder's equity is greater than the minimum margin requirement for this account. So we're good, though we lost $25,000. Unfortunately, day 3 is also a red day, right? So now Microsoft, which was we had a portfolio of $25,000, it's now only $10,000. Disney is only $15,000. Airbnb is $18,000. Square is $10,000, right? So now let's calculate our portfolio's margin maintenance amount. So these are the margin requirements, maintenance requirements, and you calculate that. Again, to calculate this 4,000 here, all you have to do is 40% of 10,000, you get 4,000. And similarly find it all for all the stocks that we have. So you get, add them up, you get $28,250. So our account equity should be at least $28,250 for the margin maintenance. Now you add all the market value of our account, it's only $53,000. Remember, we started with $100,000. So we lost another $22,000 compared to the previous day. So now what is our equity? Because this whole entire $22,000 will come from our equity, right? Or the account holder's equity. So again, the account holder's equity is going to be the total market value, which is 53,000 minus the borrowed money, right? So 53,000 minus 25,000, you get 28,000. So now we only have 28,000 equity in our account. So what percentage? That percentage comes to 52.83. So we only have 52.83% of our own personal equity in this portfolio. Now let's compare that with the margin maintenance required in this account. By the way, we got this 53.30 by when you divide 28,250 divided by 53, you get this, right? So in this case, the margin maintenance is higher, so we are not maintaining the minimum required for a margin account. So the day sucked. Also, we get a margin call. So on this day, we get a margin call because we don't meet the minimum requirement for maintaining a margin account. So next thing is to calculate how much amount that margin is going to be, margin call is going to be. Basically, what's happening behind the scenes is Robinhood or whichever brokerage you use is kind of scared. First of all, they have to follow the rule. Second thing is now they're scared because now the account holder only has 28,000 equity, right? 1 or 2 more days of loss, now they'll start losing their money. They don't want that. They want to stop it. So you get a margin call, and how much is that amount going to be? Calculating that is pretty simple. So the account holder's part of equity is 28,000, and to meet minimum margin requirement, the account has to be 28,250. So basically, you have to invest $250 more. So when you get a margin call, you'll have to deposit at $250, which will add to this 28,000, which will make it 28,250, and it will meet the minimum maintenance requirement. But practically, on the next day, if the account is going to drop further, if it's a red day, then you're going to get another margin call. So the problem is when market goes down, it sometimes goes for like days on end, maybe 1 week, 2 week, it might go down, and you'll keep on getting this margin call again and again and again. So that's something you need to think about when you have a margin account. So hopefully you don't have more questions on this particular topic, but if you have, please let me know in the comments. That's all I had for today, folks. Hope you all are staying safe. Merry Christmas. Hope you'll have a wonderful New Year as well. Bye. Ciao. See you in the next video.